Hi guys and welcome back to Yashi. In this video we're going to address the latest Federal Reserve meeting, what they stated, their interest rate increases, their future outlook and strategy, what the market thinks, and I'm going to add some personal opinions about the market in general right now, the economy and what is happening. So let's get to it. This is a scripted video, so you won't be seeing me looking at the camera all the time. It's a long text. I want to be as accurate as I can. Thank you for the patience. The other day, the Federal Reserve raised interest rates by 0.25%, as stated in the policy statement released after their meeting. The statement indicates that inflation remains elevated, but still subsided. And the committee aims to achieve still, after all what happened, the 2% targeted inflation rate over the long term. The Federal Reserve also stated that they plan to continue raising rates and reducing their holdings of the Treasury securities, agency debt, and mortgage-backed securities as part of the goal of bringing inflation back down to 2% will remain. The next interest rate increase is expected on March 22nd and May 3rd, and it's anticipated that the Fed funds rate will reach 5 to 5.25% after these two hikes. The market predicts that the Federal Reserve will stop raising interest rates after the March 22nd. So some people say that the Fed will continue until May, but the market generally expects that the Fed will stop after the March hike. On the other hand, the quantitative tightening will still continue, meaning that the Federal Reserve is reducing their balance sheet. Quantitative tightening is the opposite of quantitative easing, which is printing money. Quantitative easing is the Federal Reserve buying these securities. Quantitative tightening is the Fed taking away these securities from the balance sheet, taking away money from the market, which is, the opposite. You want to put yourself in a position to, let's say, fight against a potential crisis if it will come. As per now, the US, Federal Reserve is in the best position compared to many other central banks around the world and different countries to fight a recession, because we have the highest interest rates compared to everybody else, so the highest and biggest cushion to fight and increase and incentivize, investment if a recession would hit. During the press conference, Jay Powell made a statement regarding the lag effect of the previous year's interest rate increases, indicating that they have yet to fully affect the economy. Jay Powell, once again, for the third time in 3 consecutive meetings, has been talking about the lagging effect of their policies. He also mentioned that inflation has been easing and the labor market remains robust. The housing market, business investments are both weakening. Nevertheless, the Federal Reserve will maintain a restrictive monetary policy to bring inflation back to the 2% level. And Powell emphasized that ongoing interest rate hike increases will be necessary. So even though the situation is getting better, Powell is still very strong against inflation, is saying, guys, we're not done yet, don't get too chill, be calm, be patient, we're getting in a better place, but we're not done yet. In response to questions from reporters, Powell acknowledged that the Federal Reserve will consider the recent loosening of financial conditions and mentioned that unemployment needs to rise meaningfully to at least 4.5% to bring the labor market back to a good equilibrium. When asked if the slowdown in inflation has changed the Federal Reserve opinion on unemployment, Powell stated that it would be optimal to have disinflation while maintaining a strong labor market. So in a perfect world, it would be nice to keep the employment where we have it now while inflation goes down, but technically it is very hard to reach. If you have a market, a labor market that is very strong with no unemployment, companies will be struggling to keep people or to hire people. And their only way to hire people is to increase and compete against other businesses, especially with salaries. If salaries are being increased all the time, people have more money and people will spend more money. So the concept of bad news is good news for the market is exactly this. We want to see a labor market that is slowing down, a labor market that is a little weaker, so people get a little scared and they start saving more, they start spending less, instead of seeing a very strong labor market which incentivizes salaries, which incentivizes consumption, and will either delete completely the effect we saw on inflation the past couple of months or slow it down, so it will take us longer to get to the 2% target. Furthermore, let's continue here. During the same meeting, a reporter asked about further rate increases. Powell from the Federal Reserve confirmed that there's still work to be done again, and that the Fed plans to make data-dependent decision at the next meeting on March 22nd. The inflation report for January and February will play a crucial role in the decision making. Another reporter asked about the necessity of continuing raising interest rates, and Powell replied that inflation is still running hot. Again, people keep on asking, Powell keeps on responding the same exact way, but it is true, we're still at 6%. 6% is immensely high if you think about it. With goods inflation coming down, but services inflation staying still where it is, it's not really moving a lot. Powell stated that it's still an ongoing battle, hence the need for more interest rate hikes in the future. When asked about potential pivot, this is very important. Pivot means that from going up, now the Federal Reserve decides to pivot and go down with interest rates. Powell stated that the Fed will not pivot in 2023. If the economy is not in pain, but if there is a severe recession, they might consider going back down with interest rates. So, Powell literally stated that in 2023, they're not planning to cut interest rates. They will get to the target rate they have and stay there until the conditions do not improve for inflation. If there is a crisis, then yeah, they will drop their interest rates. But if everything stays where it is, if we're going to have a soft landing, so a landing towards a 2% inflation rate with no recession, the interest rate will stay where it is. Historically speaking, we are still under the historical, let's say, general interest rates. Remember that in 2008, before the financial crisis, mortgage rates were around 7 to 8%. Before that, we saw the Federal Reserve rate above 15%. So if you do an average across the past couple of decades, we are still in a very low spot. Now, we got used at 3% mortgage rates, but it is very unrealistic. That was a consequence of the post-crisis and the pandemic we had very recently. So we should be getting used to this more, let's say, normal state we are in right now. It sounds crazy. We got, let's say, spoiled a little bit, but the current situation is a more natural situation. Powell also noted that there's still a chance of inflation falling back down to 2% without a severe economic downturn, what I just mentioned. The topic of debt ceiling was also brought up, and Powell emphasized that the Congress must raise the debt ceiling, as it's the only way forward, and any deviation from this path will be highly risky. Powell said we need to raise the debt ceiling so the government can survive, all the government jobs can still be paid, and we avoid a recession. Basically, the way I interpret this, and this is my interpretation, not financial advice, is let us, the Federal Reserve, do the job of inflation. You guys just do the job of not failing. Of course, you need to do a better job at improving your budgets, spending less, but do not make the government fail. Very interesting point. I might link the whole meeting here on the description below for you to see the whole statement. But very interesting point, as on paper, increasing that ceiling is increasing consumption and will have little effect, but still an effect on inflation. Theoretically speaking, this is basic economics. With that said, if you look at the video of Jay Powell, for the second consecutive time, he seems to be much more tranquil about the whole situation. He seems much stronger in his opinion, less insecure about the situation. Inflation is coming down, he's more comfortable. We're not at the target yet, but right now he seems to be the one who is affecting the market correctly. He's coming out as the victor, and you could see it also in his tone in the conversation, which is good. Now, in terms of future outlooks, we saw that the market expects 1 interest rate hikes. Powell talks about 2 interest rate hikes for now, as they're observing the whole situation. Will these rate hikes have impact on the future couple of quarters? Of course they will, not as strong as what we saw last year with the 75 basis point interest rate hikes, but they will have an effect. The question is, what will those other 4% we saw last year in increases, what kind of lagging effect will they have on the economy? We saw everything slowing down a little, but we saw many industries that haven't been affected a lot yet. Unless you live in specific, let's say, for example, real estate markets like in California, many of the real estate markets around America weren't affected too much because, strangely, we had the opposite effect. Instead of seeing more sellers getting rid of the houses as soon as possible, sellers backed out. We have again a problem of supply and demand, so there's no homes for sale. Yes, there's less people wanting to buy, but there's no homes for sale. Services are still pretty expensive. Food is starting to decrease a little bit, except for eggs. Gas prices increased a little bit in January, but they're now starting to decline again because the supply chain is improving. So there are multiple different factors that seem to be pointing inflation towards again an uptrend or a downtrend. It depends on how the data will be read and how strong the different, let's say, factors will impact the inflation data. We know that the gasoline has less of an impact, although towards the data that the Fed looks at, although gasoline affects many other sectors like its transportation, also food, for example, with fertilizers, etc., etc. We're gonna probably make another video to go down on more of the market data, but as per now, what we saw is Mr. Powell being stronger in his voice, more comfortable, increasing rates at a lower pace. Inflation has been beating market expectation for 3 months in a row. When I say beating, being better than what the market expected. So as per now, the sentiment seems to be pretty good. The stock market reacted positively in the day of the Federal Reserve release. We're gonna see how it goes on. I might release a video also when we have the next CPI and PCE report. I hope this helps out. Thank you for watching, guys. Ciao!